Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, October 29th, 2018. In this video, we'll do something a little bit different. I want to take a quick look at the markets via technical analysis, which is usually what I do, looking at the charts, price action, volume, all the indicators to try to determine where the markets might be headed. But then I want to spend a little bit of time talking about some fundamental developments which could have a big impact on the market. Fundamental analysis is the other discipline in investing and trading. You have your technical analysis, which again is looking at charts to try to determine where prices are headed, whereas fundamental analysis is akin to kicking the tires. That's what Warren Buffett does. He's famous for, digging into a company, looking at the balance sheet, trying to look at any catalysts the companies might have to try to figure out where it's headed in the long run. And fundamentals over time do play out, and that's what a lot of investors use. But they can take quite some time, sometimes even years, to really be reflected into the company's stock price. Technical analysis is more commonly used by active traders, day trading, swing trading. But some of the best trades are when the two come together, and you can make a clearly bullish case, both technically and fundamentally, on a stock or the markets, and or likewise on a bearish case when the charts and the fundamentals align. So we'll do a quick overview of the charts here, and then we'll roll into some of the fundamental developments that I'm noticing that could have an impact here on the direction of the markets in the coming months. This is a monthly chart of the S&P 500 or the tracking ETF SPY. This goes back decades, back to the late 80s. And you can see the previous bull and bear markets right here. You had this uptrend line, that's your bull market uptrend line leading into the 2000 highs. That was our dot-com bubble, which popped there, followed by a pretty vicious bear market. Doesn't look like much because I use log scaling on these charts, but that was a big bear market right there. Then we had a bull market that terminated in the 2007 highs. That was with the housing bubble, financial crisis, and then we had a pretty vicious 55% drop there. And you can see, of course, it was defined by the bull market uptrend line. And then here's the current bull market. I have a few minor uptrend lines here, but this is our primary uptrend line off the March 2009 low. So when we look at a monthly chart, we're still above or holding, at least we haven't closed below the trend on a monthly closing basis yet. You can see that trend line there. I have a little minor trend line, but here's the blue trend line. And there's also this 20 period monthly exponential moving average. So I like to use that on a monthly chart to help define bull and bear markets. Does a pretty good job. In fact, let's go to QQQ and look at that real quick. Okay, the same chart, and you can see it goes all the way back to the early 90s. And here's your, bull market uptrend lines and the bear markets. So QQQ, you can see, is still above the trend line off the late 2008, early 2009 lows. There's our bull market uptrend line. And there's that 20 period monthly moving average, exponential moving average. And again, it does a great job of, you can see here, defining the uptrend, capturing, saying that you're in a bull market up until that point where it was broken. Same here. These longer term charts, when you get to the monthly charts on away from the daily and weeklies, the buy and sell signals and the trend indicators take longer to come. So there's a good chance by the time we have a monthly close, if we don't get it here this week, then it'll take until the end of November to have a monthly closing candlestick at best below here, and as well as that 20 period monthly moving average. But you can see it's done a great job. And again, I always talk about waiting on a monthly chart to have a monthly candlestick solid impulsive close. All of these candles where it was pierced intra-month, you can see it did a perfect job either closing right on the 20 period EMA or above it. So pretty much since the bull market started early on back in 2009, shortly after, this trend indicator has kept, at least this one trend indicator has remained bullish, as is the fact we're above that trend line. But again, a lot of evidence on the weekly charts tell us that that could be in jeopardy soon. So as we go down to the weekly charts here, these are the uptrend lines on QQQ, the minor uptrend lines, I should say. They're multi-year trend lines, are significant. And last week we had the impulsive break and close below the trend line and the 40-week exponential moving average. We're still below that today. And the same story on SPY, the S&P 500 tracking ETF. We danced on both the trend line and the 40-week moving average for a couple weeks and then gave it up last week with conviction. So, based on this chart, at best right now, I think we'd be looking at, a kickback rally to maybe back test those, but I still favor a move down here, down to and quite possibly below the early 2016 lows. I'm sorry, the 2018 lows. And short-term stuff, these are the 60-minute charts or 15-minute charts. This is that golden trend line that was highlighted last week. Again, today we had yet another tag of that on the SPY. QQQ is still a little bit below its trend line, but there it is. Lots of reactions on this trend line. It's been capping all the advances, keeping us in a downtrend line. And today we popped up, hit it, and so far have reversed. And QQQ, you can see we're a little bit reversed, just a little bit shy of it. Okay, now let's talk fundamental analysis and where I think that could impact the market here. All right, so what we're looking at, this chart is, let's size this out a little bit better. There we go. This is called the efficient frontier. This particular one I pulled off the internet. There's a lot out there just like it if you Google the term efficient frontier. This one's from Young Research. And they're similar. And what it shows you essentially you have risk on one axis down here below. When you go out here, you're increasing your risk. And on this side, you have the returns. And what they're looking at are average annual returns going back 40 years, from 1977 to 2017. And they use the S&P 500. And for the bonds, they use the Merrill Lynch 7 to 10 year Treasury Index. So now the point being, historically, stocks and bonds have an inverse correlation, meaning when one goes up, the other goes down. Part of that is when the stock market is coming under selling pressure, institutions will flock and individuals will flock to safety instruments, and treasuries are the king of the safe haven assets. U.S. treasuries are guaranteed to pay back their principal if you hold them to maturity, and so they tend to be a safe haven place for the institutions to move money to when things look ugly. And because they are safe, they pay a low rate of interest. And you can see down here, if you had a portfolio for the last, again, going back the last 40 years, and 100% bonds, you'd expect a return. Your average return would have been about 8% a year with very little risk. And of course, when you start adding stocks in, you're increasing your risk. But something happens, and this is why we look at the efficient frontier. When you begin to add equities to your portfolio, early on, you start to actually lower your risk. So we're coming back down on that risk spectrum, and you're boosting your returns. Now, how is that? Well, because you're adding the stocks, which of course have higher returns, and the fact that you're putting bonds in there tend to cushion the periods where one pulls back, the other goes up. So as you move it down the line and increasingly add your equity exposure, you can come all the way up here. We don't have a circle here, but that's right above that where you were in 100% bonds. And right there, I'm just trying to extrapolate. Maybe that's 35% stocks, 65% bonds, somewhere in there. You have the same amount of risk with considerably, boosting your returns considerably from about 8% to 9%. Now, as you move out on the spectrum and increase your equity holdings, you're certainly increasing your risk and you're increasing your returns. All the way out to 100% stock portfolio would have averaged somewhere around, about 10.8% a year or so. Again, that's over the last 40 years, but you tend to have a lot more volatility. Remember, during the last bear market, we dropped 55%. The previous one before that, I think it was, if I'm not mistaken, more than that. A minimum bear market, by definition, is 20%. You're usually not going to have a 20 or 50% drop in a bond portfolio. So when you come up here, there's certainly you're increasing risk quite a bit. Now, what professional hedge funds and pension funds, those, and as well as the old rule for most investors that are investing long term is to have about a 60-40 mix, 60% stocks, 40% bonds. You're not taking too much risk, but you're having, you have a nice boost to returns. And again, the point being that the bonds will normally cushion the downturns in your stock portfolio. So that's the old golden rule right there, if you will, or standard in a lot of long-term investing. Pension funds and all that tend to track that model, 60-40. And let's look at how that works. Okay, so what we're looking at here, this is a 10-year chart the S&P 500 in white with TLT, which is the 20 plus year government bond ETF. So I want to illustrate that historical correlation between stocks and bonds. And let's zoom in a little bit. Let's just go back and look at what happened back here. So we started this bull market, kicked off in 2009. And you can see we've had a couple corrections along the way. So what I want to point out real quick, so here's the S&P 500 on top. So here was our first big correction, came back in 2010. You can see the S&P 500 dropped. Again, this is log scaling. That was a substantial correction. May not seem like much when you're looking at the whole bull market in view, but it was double digit. And you can see at the same time, almost like clockwork, treasury bonds fired on all cylinders. So when your stock portfolio fell, your treasuries went up. Now, the treasuries won't go up dollar for dollar when the stock market drops, or at least not in percentage terms. But again, it helps to offset and cushion some of the losses. So what happened again, we had another correction in 2011, about a year later, sharp correction there. Same thing, especially when the correction really started, that waterfall sell-off, you can see treasuries shot up. And this is what's happened for decades, for many years. This is just an old standard investing. Another correction, another boost in treasuries. And then, of course, the market rallies, and then everyone starts to sell out of those bonds. Why hold safe instruments when you can have these type of gains? So you can see the pretty clear inverse correlation there. But here's where I'm going with this. Recently, something different happened. Before I get into the recent, here's one more correction. We had that big drop in 2015, two drops. The first drop didn't do much, but there was certainly a spike in treasuries. And we had another drop there. Oh, that was the second one that didn't do a whole lot. But the first one, you did see that flight to safety there. Now let's fast forward to this year. Okay, here's 2018. I'm zooming in, and let's do it this way. Okay, so this lets you see it a little better. Here are the two big drops we had earlier in the year. We had that high back in January. We dropped into the early February lows, sharp correction. That was odd because we didn't see the usual pickup. You saw treasuries fall in line with equities. However, by that second drop, which was actually a little more in magnitude, that one was from highs to lows, at least in the NASDAQ 100 was a little bit higher. This was about a 12.5% drop. And then at that point in time, we certainly saw a concurrent spike in treasuries. This is my concern right now as we've zoomed in. Let me get rid of this little trend line to today. We've seen there were a couple things that make this most recent drop different, in my opinion. Technically speaking, for all the reasons I cited, those other two drops just took us back down. They were just corrections that took us back to the long-term trend lines, 40-week moving average, and they were buying opportunities. They had divergences at the bottom and everything else. So the charts indicated we'd bounce. And again, we only came back, we pulled back to key support after being well above it. This time around is different. As I just showed you earlier, we've broken long-term supports. So that makes it different, number one. And you can see it's been a pretty significant drop. And all the while, we had treasuries fall right in line with the stock market. And you can see even since this bounce here, treasuries are sort of trading in line with stocks now. This, to me, is a colossal problem, very big. Now, it may prove to be fleeting. Sometimes you do see these temporary disconnects. But if this trend continues, and I think it may not even have to continue, my theory here, and I've mentioned this recently, is that the big pension funds and hedge funds and those type of professionally managed portfolios that need that count on this diversity, their risk models are breaking right now. They're busted. You cannot get down to this point and then start hedging up protection. Because what happens is once we have a sell-off like this, the VIX shoots up, premiums on options are very high. So hedging is not cost effective anymore because of those huge surge in the premiums to buy puts at that point. You buy them up here, they're cheap. You wait to buy puts after a big drop like this, they're very expensive. So what does that leave you to do? Well, you have to then start reducing your holdings. And so what we're going to do is take a look at CalPERS real quick, and I'll give you some thoughts there. Okay, CalPERS is the largest pension fund in the country. It's the California Public Employees Retirement System. They have about $350 billion in assets. So, and like most pension funds, many of you have probably heard of this. For years, there's been talks about how underfunded the majority of these pension funds are, and it will be a big problem sooner or later. Potentially, a catastrophic problem for our country. And, of course, the U.S. government's not in much better shape. We're running a huge federal deficit. But let's just talk about CalPERS real quick. Back in 2016, they were only 69% funded. That means the amount of money they have plus, keep in mind, based on their projected annual returns versus the benefits that they have to pay out. So they were about over 30% underfunded. They were getting up there in 2017. We had a huge market rally. Stock S&P was up almost 22%. That brought them a little bit better. But then, if my numbers are correct, by the end of the year they had dropped back down. They were only 68% funded as of December 17. Again, if that number. So either way, give or take, we're about 30% underfunded. There are some municipalities better off with their pension funds, and there are quite a few that are worse off. But being that this is the biggest one, I'll use this example. So now going back to what I talked about before, the old, 60-40 basics split. Here's CalPERS. This is, once a year, I guess they'll update what's going on there. The most recent I could find was there was a few articles back in December of 2017, that they increased their equity exposure to 50%. So, and that was to go into effect July 1st, 2018. So on July 1st, 2018, CalPERS went from 46 to 50% equity, global equity. They went from 20 to 28% fixed income. Tells me that they were hedging up, expecting, wanting that fixed income to help cushion any downside in the equity portfolio. They kept their real assets, which include real estate, at 18%. Here, let me show you this chart right here. Here's the ratio. So 50% global equity, 20% fixed income, 13% real assets. Again, that also includes real estate, and that's commodities, things like that. 8% private equity and 1% liquidity, down from 4% liquidity. So that also tells you something, that they're running real low on their cash reserves, going from 4% liquidity down to 1%. And the big thing, in my opinion, and there's just really no way around it, short of some phenomenal stock picking, but you have to assume that their global equity returns are roughly in line with global equity indices. That's U.S. and non-U.S. countries. So normally, again, when this isn't firing, right here, this cylinder is supposed to fire and kick in. But what we've had are concurrent drops in both, and that's the bulk of their holdings. And in fact, a lot of the real assets are down as well. So and now keep in mind that CalPERS is assuming an expected annual return of 7% over the next 3 years from there. So far, year to date, we are down. The S&P 500, global markets especially, are in negative territory now. Bonds are down for the year. This market's going to have to do some amazing fireworks for the next couple months to come in and somehow pull off that 7%. Because what happens with these models, if you go from a 7% expected return this year, and let's say we finish the year down 7, well, now you have to do 14 next year. And then, or, average, make up for that over the next couple of years. Based on everything I'm looking at, I think the odds are extremely slim that from this point they're going to meet that return. So now what they're going to have to do, if this market continues down, and even from this point, they have to start reducing risk exposure. The charts are ugly. There's a lot of technical damage done. And again, I'm just using this one example, and I think this will spill over. And this is why we could be looking at, another big swoon down here in the market as these, funds, because they cannot, unlike the retail investors, like in the last bear market, and I know this to be the case, a lot of retail investors do the pray and hope thing, where buy and hope. When the market starts sliding, they hope and they ride it down and they capitulate towards the bottom. Professional fund managers can't do that. They can't watch this market drop another 10, 15, 20%, hoping that it's going to spring back. At some point, their risk models are going to dictate that they have to reduce equity exposure. So that's something that may impact this market, and that's where we can get that waterfall type sell-off. As I went over before on the charts, let's go back to that real quick. I think it was in Friday's video I talked about this, and I gave you the returns. In fact, let me see, I quoted them on MDX or QQQ. And yeah, there it is. I talked about these drops that we've had here. Forget about these lines. That first correction earlier this year was a 12% drop in about 10 sessions. This one's a 12.5 and 13 sessions. And this one through Friday was 12.5% drop in 19 sessions. So these were more impulsive than this session, this correction so far. So my point is this is not an impulsive sell-off. This is not a waterfall type sell-off that I'm talking about. That can and most likely will come if and when these big institutions are forced to unwind. And then the final part of this, let me look at one more thing here. Okay, the final potential nail in the coffin. I've talked about this in the past, as I imagine others have, but these charts, as you can see, are from advisor perspectives, and it shows you margin debt in the S&P 500. And plain and simply put, as a bull market ages, matures, you see margin debt go up and up and up. And these are margin debts from longs. Majority of market participants, as I've mentioned before, are long side traders. Shorts make up a very small portion of the market. And as the stock market goes up, people develop that mentality that it's like an ATM. It's just going to print money. So why not borrow? Why just, if you have 100,000 invest, why put 100,000 in QQQ or SPY or Apple and Amazon? Why not leverage up? Your broker will allow you to buy several times that on margin. You can go 2, 3, 400,000, and more than that if you want to trade futures. And so what happens is you have a peak in margin interest that coincides with a peak in the stock market. This is, by the way, the S&P 500 in blue, margin debts in red. And you can see there's usually a surge leading right up to the top. And there's the gray lines are recession. So there was a dot-com bubble back in 2000 right here. This was the housing crisis or housing bubble right there back in 2007. And here's our current Fed bubble. And you can see in 2007, same thing. Everybody gets giddy. At the top, it looks like the market will go up forever. Everything's rosy, and that's what's going on now. And so you can see we also had a big surge from about this point here. Here, let's just draw these out. You had a big surge again in margin interest recently, and we're now at extreme levels or coming off those extreme levels. And the other thing is, too, you can see recessions. I've always said this. Recessions are identified in hindsight. By the time they come in, because they revise the data after the fact, and that's something else. I'm going to digress for a second that scares me. I look and read a lot, and nobody, and I mean nobody right now, even some of the most ardent bears, nobody's calling for a recession. They're saying, well, we're going to get one, but it's not on the horizon right now. And remember, just there's an old adage in Wall Street. It's always darkest just before the dawn. That's what you want to remember back in 2009 when it looked like the world was going to come to an end in March of 2009, and that's when the economic forecasts and outlook and everything's as grim as it gets, and then from there market bottoms. Same thing in reverse happens at the top. I'll say the corollary would be it's always brightest just before dusk, let's say. But either way, that's what's going on now. And remember, the markets top ahead of a recession. They always have. The market looks out 6 to 9 months ahead. And the other thing is, it's funny because I've seen all types of articles, in the journal, Wall Street Journal, Barron's, everywhere else, that some seemingly smart people write what would be the next triggers for the next bear market, and they list all these triggers. They talk about the trade wars and geopolitical events and Saudi Arabia killing the journalist recently and all these things. But I have a theory that it's not going to be any of that. It's just the weight of the market collapsing on itself. We've had a tremendous run-up, one of the strongest bull markets, the longest bull market in history, and the technicals are clearly there. So what I think happens is this selling will continue to, once you have all the buyers in the market and it just collapses under its own weight, when the last bull has bought his or her last share of stock with their last dollar, that's when the bull market ends. And so as you go down now, what happens is consumer confidence and the stock market are a coincident indicator. They run hand in hand. Stock market goes up, consumer confidence is boosted. Ben Bernanke even said it when he said he was going to gun the market. He didn't try to hide it. He said part of the point of quantitative easing was to gun the market, to lift the stock market, to therefore raise consumer confidence, which would increase consumer spending. And for those who are not familiar, consumer spending accounts for about 2/3 of GDP, gross domestic product. And that's what they measure recessions on. It's declined as two contracting quarters of GDP. Or two negative quarters, I should say, not contracting, negative quarters. And so there it is. If the stock market does fall, if we have another, let's say from here, 10, 20, 30% downside, what will start to happen is even if just another 10% or so downside, economic expectations going forward, the outlook will start to be revised downward, and it will have a vicious cycle. Again, as consumers start to tighten their pockets, then it will have a domino effect, if you will, on corporations, and then earnings start to go down, and then again it's all cycle, and the cycle tends to repeat, and it always has. So that's some of the thoughts I have on the market right now. And just one more chart, also from advisor perspective. Same thing here. It shows you what they did here is show you the credit balances. If you look here, this is the Fed bubble, and they inverted the credit balances here to show you, we're looking at margin, the credit balances and margin account minus margin debt. And you can see here back in, here's the tech bubble. Since they inverted it, you can see that it peaked right there when the market popped. Here's the 2007 market high and the Great Bear. Look at where we are. Look at this massive amount of investor credit. This bubble, when it unwinds, is going to be enormous, and I think it will have very long lasting. I don't think we're going to see a meltdown where the market drops 55% in a year and a half or less, like it did back in '07. I think we're in for a more prolonged. There will be some sharp rips and dips along the way, but again, when this bubble pops, and it may have started to pop, and like I said, everything I just showed you, if it continues to drop, it will be a domino effect with these large pension funds and hedge funds and all types of other, balanced accounts that have to protect, and as well as individuals, they're going to have to start cutting their losses at some point. And so it could have some really big implications and trigger that waterfall type sell-off, which again, we really haven't seen yet so far. On a final note, a couple other things to mention. I've mentioned this in recent weeks. We haven't seen fear, not the fear that I watch a lot of fear indicators. I watch the VIX, I watch sentiment surveys, bull to bear ratios, the various put call ratios, such as index only, equity only. They were not hitting, not even coming close to the extremes that I like to see. I only use sentiment surveys or sentiment as contrary indicators when they hit extremes. Anywhere in the middle is useless to me. But when they hit those extremes, either extreme bullishness or extreme bearishness, that usually is a good chance or a good signal that a bottom or a top may be in. We haven't hit that yet. That to me is dangerous. The other thing, I was reading up recently, and the Bank of Merrill Lynch, BOA Merrill Lynch data suggests that ordinary investors have been buying the dips lately. Pros have not been buying the dips. So that's something to consider. That's something I mentioned recently. I talked about the charts on the way down, that it looked like retail buyers stepping in when we look at the recent 15-minute charts, watching the markets go down, 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 watching all these rips get sold into. These are retail investors, according to the data. And that was my assumption or my read on the charts early on. And again, I just read that in Barron's over the weekend, that the BOA Merrill Lynch data suggests that it is retail investors. And no offense to those listening to my voice, they're referred to as the dumb money, and the smart money is not buying. And that again helps to affirm everything I just talked about with these pension plans. They cannot continue to double down. In fact, they're probably on the defensive now, and there is a ton of money there. And if they sell, and I always say these type of sell-offs, selling begets more selling. That coupled with the extreme amount of margin in this market, you start getting margin calls. That bubble is going to be unwound, and that's what we could be looking at. So again, the near-term outlook to me remains bearish. I'm talking intermediate. I'm talking this week and into next, and probably into the end of the year. Now, near term, we may bounce. I put up some charts this morning. We may take these trend lines out sooner or later. But so far, I don't know. Earlier this morning, I was looking for that, a possible pop above here and run, but we couldn't. We failed. Like I said, SPY failed earlier right here at that trend line. If it could have popped it, I was looking for a run up, maybe up to 274.48, but so far another rejection there. And it's amazing how many times that we can fail at the same trend line. So let's leave it there. And again, that just speaks to some fundamentals that may happen here. All this stuff about the unwinding, of pension funds and safe money investments. All right, well, we'll wrap it up here, and I'll post an update on the markets in a little bit here with some more technicals and some levels to watch. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.